Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Karen McCormick of Beringea to talk about the ProVen VCTs. First off, just tell me about the ProVen VCTs. What are they? What do they aim to do for investors?
Yep, sure. So Beringea is the manager of the ProVen VCTs. Beringea has been around for over 30 years, and we've been managing the ProVen VCTs for about 20 now. The ProVen VCTs are targeted at delivering a 5% dividend every year that's paid out of profit rather than capital. Traditionally, we have consistently exceeded that 5% and continued to grow the VCTs. So that's the baseline delivery.
And why are they different from other VCTs?
Sure. So the ProVen VCTs focus on early stage growth capital. What that means is we invest in companies that are commercially proven. So we don't do pure seed or startup. We look for businesses with commercial traction and a clear route to profitability. We tend to look for businesses that have revenue of at least $1 million, but the sweet spot for us is anywhere from $1 to $10 million in revenue. And because of the management company's U.S. presence, we also look for businesses that can be commercialized in the U.S. It's not a requirement, but for us, we've had on-the-ground resources and traction in the U.S. for 30 years now, and we can help with fundamental things like where should I locate a company and establish a tax nexus to actually giving a desk and introducing businesses to new customers in the U.S.
So over the last few years, you've raised quite a lot of money. How much are you raising this year and why?
So this year we're raising $20 million with an over allotment of up to another $20 million. That will go 50-50 to both of the VCTs. And we're doing it purely because there's demand for it. We are spending the money that we have relatively quickly, and we forecast that the businesses or that the VCTs are going to need further funding within the next couple of years.
Okay, do you want to talk more about the types of companies you look for then? You've mentioned they are sort of slightly later stage, but just give me some examples.
Yeah, of course. So I'll kind of categorize this by stage and then sector. So I mean, stage, as I mentioned, generally 1 to 10 million in revenues, and that can range anything from a relatively early stage business with around $1 million in revenue that's still quite loss-making to a later stage business with in excess of 10 million that's either break-even or profitable. And we invest in kind of that range. In terms of sectors, the bulk of the portfolio is made up of business software and services, mainly SaaS companies, and then consumer and consumer related. And that could be anything from traditionally a watch finder, which we sold in 2018, which did luxury used watches online, to data analytics businesses selling into the consumer products industry. So those two sectors will make up about 2/3 of the portfolio. The other third of the portfolio would be all kinds of tech-enabled businesses. So it could be fintech, edge tech, health tech, etc.
Okay, and can you give me some examples of recent investments you've made?
Yeah, sure. So in the last year, a couple of interesting investments. One would be a company called Arctic Shores, which does gamified psychometric testing. And it primarily sells to large corporates like Cisco and Siemens, who have large graduate recruitment programs. And fundamentally, the business offers graduates psychometric tests that are delivered through mobile games. And not only does it allow the corporates to have a better hit rate in terms of their recruitment, but it also helps eliminate or reduce gender and ethnicity biases as well. So we did that one earlier in the year. We've also invested this year in a company called Papier, which is following the consumer theme. It's a luxury personalized stationery company. They're really capitalizing on kind of the return to analog and quality of offline life, where we see consumers embracing kind of traditional handwritten stationery. And that could be anything from wedding invitations and greeting cards to actual letter writing and journal keeping. That business is doing very well. We also invested in a very exciting business called Fnatic, which is kind of a crossover between the technology and consumer themes. Fnatic is in the esports industry. Esports basically means professional sports teams that play video games, like Fortnite or League of Legends. Fnatic runs 10 teams internationally. They are a global market leader and certainly the leader in Europe. And that business, for us, the market is just an absolutely explosive market, and Fnatic is a clear market leader.
And what about more mature companies you've got in the portfolio?
Sure. So one of the old favorites, Monica Vinader, which is a jewelry company that has done incredibly well for us, and we had a partial realization of that company a few years ago that was nearly a 6 times return. We still own a significant portion of Monica Vinader, and that business continues to do well, having expanded into the US well, following our partial realization. Some of the other companies in the portfolio, a business called MPB, which for your viewers who might have been familiar with our portfolio, is effectively watchfinder for camera equipment. So they buy in high-end camera equipment that was pre-owned, refurbish it to a new standard, and then resell it back to the public. So those would be a couple of the portfolio companies that are a little bit on the more mature side.
And how involved are you in these companies?
Yeah, good question. It really varies. In some instances, the best thing we can do as investors is stay out of the way, and gauging when to do that is an important character trait for us. But we do tend to get quite involved in certain areas. So the areas that we tend to be able to add the most value, one is entry into the US, because we have the US presence and experience there. The other areas are often defining what the team in the organization could look like or should look like, and then helping with the recruitment for it. And often that means augmenting the senior team with people like finance directors or commercial directors. We do run a Beringea Academy, which has roughly monthly events where we do kind of deep dives into best practices for business areas. So that includes how do you go into the US and what's the right time. It includes sales force effectiveness. It includes things like commercialization of new products. So we'll offer those on kind of a monthly basis for the portfolio companies. And then because we have a lot of experience looking at thousands of companies every year, offering just KPIs that determine best practices in different sectors is one of the things we can do. And obviously, anytime there is either further fundraising or an exit opportunity or an acquisition opportunity, because that's our bread and butter, we do tend to get involved.
And what are the challenges you're facing at the moment as a fund manager?
I think one of the key challenges, which is a systemic theme in the industry, is the size of funding rounds and the resulting company losses. So a Series A round or a Series A plus or B round today is significantly larger than it was 10 or even 5 years ago. And by definition, when the early stage companies are raising more money, that probably means they're going to be in losses for a longer period of time, either deeper losses quickly or more sustained losses over a period of time. And I think we and the industry as a whole, while we're doing the right thing, I think in terms of funding these businesses well up front rather than drip feeding them, need to be conscientious that longer sustained losses mean that we need to make sure the businesses are well capitalized, regardless of whether the market is really frothy or whether the tap gets turned off.
And what are you doing to sort of prevent that?
Yeah, so in truth, we can't prevent the market from either drying up or the money running out in terms of new money coming into the businesses. But what we can do is make sure we're prepared for all types of economic environments. So in some instances, it's just making sure the businesses are well capitalized. Right now is a very good time to raise money for any solid business. So making sure that we're raising when the time is right to raise, making sure the VCTs have enough firepower to continue to fund the businesses, because fundamentally, much of the portfolio are doing exactly what we want them to do. They're hitting their growth targets, but they might still be in loss-making stages. So we don't necessarily want to stop funding them just because they're loss-making businesses. So making sure that we have enough firepower to continue to fund the growth plans. And then we're also doing quite a lot of syndicating to make sure that we have enough firepower around the table. So most of the deals we do these days are syndicated, sometimes with other VCs, often with family offices, high net worths, former entrepreneurs we've invested in, et cetera.
And are you still finding plenty of opportunities?
Yeah, the deal flow, it's been true for the last couple of years, but it continues to be phenomenal. I mean, we in the 13 years I've been doing this, I have not seen deal flow this strong. And I think there are a number of factors to it. One of them is just there is demand. There's a lot more money in the market because growth capital and venture capital are becoming a much more proven entity and people are more willing to fund them. I think entrepreneurship is now also a career. There are enough sort of Mark Zuckerbergs in the world that students come out of university with the goal of becoming an entrepreneur, so a lot more early stage startups.
And just looking at the risks, how risky is it? Obviously the rules have changed in the last few years. How risky is it investing in VCTs, and what do you do to sort of minimise those risks?
Yeah, I mean, I'm not sure You're right, the rules changed recently. For us, that was probably not such a big impact because we've always been doing early stage growth capital, which is what the rules were designed to do. So I think it hasn't had a significant impact on us, really. It has had some impact. I don't think the risk profile of VCTs has changed massively. I mean, we take a portfolio approach, we diversify the investments across a broad range of companies. There's always going to be an early stage risk, but we have consistently won more than we've lost, which is the ultimate goal.
And what would you expect a typical failure rate to be?
It varies from VCT to VCT. For us, the absolute failure rate is quite small. I don't have exact statistics to hand, but I would guess we lose probably one company a year or every other year. For us, when things go wrong, it's more the business just doesn't achieve the growth goals that they set out to achieve, which means that they end up just kind of sitting in the portfolio for a bit too long until we can find a way to shift them.
The key thing about VCTs is actually getting an exit. Can you talk to us about some of your recent exits?
Sure. We've actually had a raft of very strong recent exits. The strongest would probably be Watchfinder, which is a reseller of luxury pre-owned watches, which we sold to Richemont. We've also exited ChargeMaster, which is an electric car charging station business. And then we also sold Chess Dynamics, which is a business that's been in the portfolio for a little while. And then we've got a number of businesses that are relatively ripe for exit that are coming up into processes for this year.
So Karen, I want to put some money into a VCT this tax year. Why should I invest with you?
Sure. I think the things we can offer are longevity and a consistently great track record over 20 years. The leadership team, the partnership team has been together for over 10 years, and we've delivered consistently over that period of time. The U.S. office, which has been established for quite a long period of time, has obviously helped commercialize businesses into the U.S. and offers a USP. And then the area in which we invest, which is early stage growth capital, rather than really startup risk, offers something a bit different.
Karen McCormick of Beringea, thank you very much.
Thank you. Pleasure to be here.